institutions, including investment funds. This event is held in collaboration with ISRA and CEF Malaysia. We would like to thank them for taking the efforts and extending their support in organizing today's public hearing. The public hearing is one of multiple steps in standards development process at AUFI and represent an opportunity for us to interact with and benefit from the knowledge, experience, and wisdom of professional individuals and experts from all corners of the industry on the newly issued exposure drafts. The exposure draft of AUP FAST on financial reporting for Islamic investment institutions, including investment funds, sets out the principles of financial reporting for Islamic investment institutions, particularly prescribing the overall requirements for the presentation, minimum contents, and recommended structure of their financial statements. Now, and without further ado, let me invite to the virtual floor the Director of Professional Standards Development at AUFI, Mr. Mohammed Majd Bakir, who will present the exposure draft and walk you through its main content while answering time to time your questions in an interactive session. Brother Majd, the floor is yours. Thank you.
Bismillah ar-Rahman ar-Rahim. I would like firstly to thank my colleague Hawra for the brief introduction. بسم الله الرحمن الرحيم الحمد لله رب العالمين والصلاة والسلام على سيدنا محمد وعلى آله وصحبه أجمعين. It's our pleasure again to hold the fourth leg of this of the series of public hearings on this very important standard, which has been issued in the form of an exposure draft recently. I would have the pleasure to walk you through the standard, and as my colleague Hawra mentioned, we would be more than happy to answer your questions, take your comments interactively on the go. So please feel free to raise any issues, any comments. If you have any live comments, please let us know, let the team know. And I just want to remind our valued participants and stakeholders that this session is being broadcast live on YouTube channel. For those who are interested and their colleagues are interested, they can also share the link. And we know not everybody can attend the public hearing live during or as part of the Zoom setup because of many issues regarding their jobs, regarding their work, regarding their daily routine. We understand that, and we would be for that purpose we'd be more than pleased if you can please send us your comments in writing for those who couldn't attend, and it would be as always our pleasure to have everybody on board in terms of their contribution and the improvement that we can make at the level of the industry to this important exposure draft. So let us go through the slides. I would like also to remind our valued participants today that our team also is be ready all the time to also help you answer your certain questions and provide any possible help. This would be also our pleasure. Our team also consists of, in addition to Hawra, we have Saira Shamsi online, and from the office Noof Sharida. So I would like to thank also the team for the great efforts they have exerted towards convention of all the legs of these public hearings. Now we are concluding with the fourth leg. We already held two in English, one in Arabic, and this is the in English. So please let me go take you through the standard, and if you have any questions, please let us know. So this part of the standard is the standard part. IOFI financial accounting standard, whatever the number is, financial reporting for Islamic investment institutions, including investment funds, is set out in paragraphs from 1 to 38. All paragraphs have equal authority, and the standard should be read in the context of the objective and the conceptual framework for financial reporting as endorsed by IOFI. And also, it should be read in conjunction with the requirements of Part 1 applicable on all institutions of FAS 1, general presentation and disclosures in the financial statements. Of course, all IOFI FASs shall be read in, this is a standard practice, and this is the basis on which all our standards, financial accounting standards are built. It shall be read in conjunction with the definitions, Sharia principles and rules, and key considerations provided by IOFI Sharia standards in respect of such products and matters. Now to the preface, PR1, Islamic investment institutions, abbreviated as triple I's, including Islamic investment funds and other types of Sharia-compliant investment entities, are a significant part of Islamic financial or finance ecosystem, particularly the Islamic capital markets. Over time, triple I have significantly evolved in their respective structure and size, which has emanated the need for improved financial reporting guidelines. IOFI PR2, IOFI Accounting Board, abbreviated as AAB, the board directed to or decided to revise the existing IOFI financial accounting standard, FAS 14, which is still in issue and still effective investment funds, and to align that standard with other newer IOFI FASs and pronouncements, specifically FAS 1, general presentation and disclosures in the financial statements, and the IOFI conceptual framework for financial reporting, the conceptual framework. PR3, this standard supersedes, once it's issued, it will supersede FAS 14 investments funds. This is, as I mentioned, this is just standard components of this standard, and we need to just dig deeper and go into the main component of the standard, the body of the standard. Overview, this standard provides financial reporting principles applicable to the Islamic financial institutions. In particular, it emphasizes on bringing harmony and standardization with regard to the form and contents of the financial statements. So in this sense, this standard is a disclosure, presentation and disclosure standard. This standard prescribes the overall requirements for the presentation, minimum contents, and recommended structure of triple I's financial statements in a manner that facilitates truthful and fair presentation in line with Sharia principles and rules. Rationale for issuing this standard, the board, while concluding the financial accounting standards review and revision project, which was started in 2018, added the revision of FAS 14 investment funds to the agenda. The proposed revised standard was particularly aimed towards aligning the financial reporting requirements for triple I's with the revised FAS 1 general presentation and disclosures in the financial statements and the IOFI conceptual framework for financial reporting, or the so-called conceptual framework. Additionally, the board also agreed on the need for determining a wider scope, which would include other types of triple I's in addition to investment funds, and to address certain pressing issues in respect of investment funds and investment entities accounting. What are the significant changes from the previous standard? This standard and then the exposure draft, currently the exposure draft, brings significant changes from its predecessor standard. Among others, in the following aspects: the scope of the standard has been extended to include different types of triple I's in addition to Islamic investment funds. So the previous standard only tackled investment funds as it's implied by the name. Now the new standard is wider in scope. Also, the financial reporting principles have been aligned with the requirements of revised FAS 1, the standard of standards, so as we call it, and the framework. the conceptual framework, whereby the standard is to be read in conjunction with, particularly, as I mentioned earlier, Part 1 applicable all institutions of Phase 1 under the title General Presentation Disclosures in the Financial Statements. In particular, the following changes have been made and introduced. Definitions and terminologies have been modified, as you'll see, and cross-referenced and improved. Certain presentation requirements, such as the statement of portfolio investments, receivables, and financing, have been aligned with the approach followed in newer AOFI phases, and hence this information is expected to be included in the notes to the financial statements, which implies that a separate statement is no more required. And the concept of cash equivalent value, though the standard is as I mentioned, is a presentation disclosure standard, but it also prescribes certain issues related to recognition and measurement, particularly the need now to remove the concept of cash equivalent value for recognition and measurement purposes, as this measurement basis doesn't fit the arena where we are talking about investments and investment institutions. Now we have different sets of measures that suit this area. Also, the concept and the financial reporting principles for quasi-equity have been introduced, whereby considering the type of the triple I, as well as the contractual arrangements with investors, it has been clarified that their investments may take the form of either equity or quasi-equity. This is also in line with the new concepts introduced in Phase 1, as I mentioned. The financial reporting principles in respect of this of the triple I's, comprising of more than one virtual entity or sub-funds, have also been prescribed. We will come into the concept of virtual entity and the sub-funds later on. Does anybody have any questions so far, or any suggestions? So suggestion can also be, not limited to the concepts provided here in the standard, but also for certain, suggested changes as to wording, the text itself, etc. Do we have any questions? No questions? In addition to the changes I mentioned, also the concept and accounting requirements in respect of net asset value, NAV, differential. I would also like to welcome to the stage, the floor, Mr. Faisal Hafiz, our consultant. Mr. Faisal, salam alaikum. Can you hear me?
Yes.
Yes, please. If we are still at the beginning, if you have, if you can just provide a few remarks, notes, your notes, if as consultant.
Yeah.
Do you have anything to mention at the beginning?
Okay. Okay, I'll contribute whenever I feel necessary, and as the things proceeds, we will see the
Okay.
comments and everything.
Thank you very much. Thank you. So let us continue. The concept and accounting requirements in respect of net asset value differential are also introduced to address the frequent entries to or exits from the open-ended triple I's by the investors. This is the practical aspects, and this is part of modern day business. The predecessor standard included certain governance requirements and additionally certain requirements related to reporting to the stakeholders, which are typically not a part of accounting and financial reporting requirements. Such requirements, as usual, have not been included in the revised standard. Now it's also a practice that we just retire all such requirements into their respective standards. Also, this standard clarifies triple I due to its unique business model and intention of investments, is and shall always be considered exempt from following the equity accounting method or from consolidating an investee company into its or their financial statements. This is for the introductory part. Now, objective of the standard. The objective of this standard is to set out the principles of financial reporting for Islamic investment institutions, particularly prescribing overall requirements for the presentation, minimum contents, and recommended structure of their financial statements in a manner that facilitates truthful and fair presentation in line with Sharia principles and rules. The scope, the standard, we mentioned, in a hurry, we mentioned part of that in the beginning. The standard shall apply to all Islamic investment institutions in different forms. It shall also apply to employee retirement benefit funds managed by the Islamic financial institution, IFIs, for the benefit of their own employees, in addition to the requirements of generally accepted accounting principles as applicable. Here, the standard explains that, in particular, the disclosure requirements in respect of the nature of underlying assets and their respective compliance with Sharia principles and rules shall also be applicable and taken care of. This standard shall not be applicable on, this is now a scoping out paragraph, of balance sheet assets under management that don't take the form of a separate legal entity and which are subject to the financial reporting requirements as prescribed in respective AOFI FAS. We have issued a standard on that, newly issued standards. Investment institutions taking the form of a waqf from Sharia perspective, which are subject to the financial reporting requirements as prescribed in their respective standard. And also reference was made to that purpose, for that purpose. Investment funds, such as participants' investment funds managed by takaful institutions, which are subject to financial reporting requirements as prescribed in the relevant AOFI FAS, are also scoped out. These standards shall be read in conjunction with requirements of, as we mentioned, Part 1, applicable on all institutions, which is part of FAS 1, whereby the provisions of this standard shall be considered along with the requirements prescribed therein about the general presentation disclosures in the financial statements of all IFIs. However, the specific provisions of this standard shall apply in case of conflict between the requirements of the two standards. Here also the override, disclosure. This standard shall apply only to the standalone financial statements of IFIs or triple I's. I'm sorry. Triple I shall not prepare consolidated financial statements in respect of any entity that it controls, nor shall it apply the equity method of accounting in respect of any entity over which it exercises significant influence. The existence of control or exercise of significant influence by a triple I institution over another entity may at times require reassessment of the business model of this applicability of the standard on in such cases. So this is for scoping out, and even within scoping out, we have certain areas where we can also scope depending on meeting these conditions or requirements. Now, also part of the standard components of our standards, the definitions. Definitions actually help, in providing insights about the concepts that we have in this standard, particularly in relation to the main theme of the standard. We have the back-end discount is defined as a discount on redemption of investment by an outgoing investor, exiting investor, against net asset value, NAV, of such investment applied in case of institution being an open-ended institution, which is attributable to the equity or quasi-equity as applicable. So as you can see, these definitions are aligned with best practices and also the concepts spread out across our FAS 1 and other standards. So you will feel that these definitions are unique in nature, as they, provide the concept from IOFI standards perspective. Back-end fee is a fee payable to the investment manager as charged to an outgoing investor, normally computed on the basis of NAV of such investment in case of an institution being an open-ended institution. Capital transactions include the inflows, such as through issuance of shares, units of investments, including reinvestment of distributable profits, and outflows, such as through redemption of units of investments by investors to increase or reduce their respective share in the net assets of an institution, and may at times include other directly made adjustments to equity, quasi-equity, such as reduction of share capital against accumulated losses. So in either way, in inflows and outflows, this is considered part of the capital transactions. A front-end fee is a fee payable to the investment manager as charged to an incoming investor on entry, normally computed on the basis of NAV of such investments in case of an institution. Also being open-ended institution. Front-end premium is a premium, if any, on amount of investment charged for or to an incoming investor on entry to the fund or to the institution against NAV of such investment applied in a case of an institution being open-ended, which is attributable to the equity or quasi-equity as the case might be or as applicable. Investment manager is defined as the institution which establishes, manages, operates, and administers an institution in a fiduciary capacity, either in exchange for or variable under al-wakala bil-istithmar arrangement or against a share of profit at times with incentives under a mudaraba arrangement based on profits or profit targets. Explanation here, an investment manager in certain situations can also be the institution I itself. Investors, as a broad term, include the participants in equity or quasi-equity of the institution. As Islamic investment institutions are defined as such Islamic financial institutions that take part or take the juristic form, legal form of corporate entities, trusts, and other financially and legally independent institutions, which by nature are established with an investment motive, that is to invest in a pool of Sharia compliant assets and earn returns on investments without an expressed intention to exercise control over the businesses underlying such investments. And second, involve investors contributing to the equity, quasi-equity of the institution, and at times a combination thereof, which represent ownership claims to the underlying assets and entitlement to respective shares in profits or losses. The standard explains that these institutions include open-ended and closed-ended mutual funds, voluntary pension schemes, real estate investment trusts, funds, venture capital institutions or funds, private equity institutions or funds, and sovereign wealth funds, family office investment institutions or funds, etc. So this is the concept of as you can see, it's wider in scope, much wider than the concept under which the old standard was issued. Continuing with the definitions, issued value of shares or units is the cumulative value against which shares or units of an institution are subscribed by the investors against such or through reinvestment of distributable profits and excluding the NAV differential. Net asset value, NAV differential, in the specific context of such open-ended institutions that maintain a nominal value of units as a statutory capital, legal capital, is an account being a component of quasi-equity used to record element of undistributed comprehensive income or loss included in net asset value of units as issued during the period less the element of undistributed comprehensive income or loss included in the redemption value of such units as redeemed during the period. So this net asset value, as you can see, reflects, different scenarios, the exit, entry, exit, and any changes during that period, any redemption that take place. So this reflects all these, operations. Any questions so far?
Yes, Brother Maj, we have two questions.
Yeah,
One
please.
question is from Syed Imtiaz Abbas Hussain. Why AOP considered GAAP and not IFRS?
Actually,
It
Sarah,
includes both things, actually. GAAP is a general term that is used for.
Sarah, okay, please take a place here and you can provide the answer, please. Sarah.
The term generally accepted accounting principles includes IFRS also. So both have been considered. It's not that it's just the gap in that way. Second question is, what strategies are you putting in place that most African countries should have this kind of opportunity in Islamic financing? In Islamic financing, and it's from an anonymous attendee. We would request all our participants to please give their name and institution name also, so it would make it easier for us.
Please, yes, that would help us later on.
Yes, brother. Do you have a response for this strategies?
May I invite Mr. Faisal, please, Mr. Faisal? Saira, if you can repeat the question, please.
The question is, what strategies are you putting in place that most African countries should have this kind of opportunity in Islamic financing?
Okay. Most African countries.
I think
Sarah,
this would be like the jurisdictions, regulators who would be taking this more so than from the standard setting body.
It's more into regulations, yeah, as you mentioned. But I would like to invite also Brother Faisal, if you have any remarks on that. Mr. Faisal. You are mute. You are still mute. Can you allow Mr. Faisal to comment? I think he's muted.
Okay, sorry. I did not realize that my mic is not working. So the question is related to the strategies on Islamic institutions so we have covered here all types of pooling and methodologies where investors pool their money and they are invested for a single purpose. So the collection of the funds is utilized for earning from different asset sources. So asset source could be different, and that is why we have mentioned in the scope that Islamic investment institutions could invest in real estates, equities, and Sharia compliant money markets, and all those areas where we have to collect investments from different sources, and then we have to combine them and then account for those unit holders who have given their money to us, given us the fiduciary responsibility. So whoever is giving the money for investment in opportunities that may exist in either real estate or equities has to have proper position of his investment performance, and this standard covers the accounting side of that. So when we have a good accounting governance system, there is a better chance of providing accurate and up-to-date information to the investor who has invested.
Thank you, Mr. Faisal.
The opportunities this standard covers all those opportunities which are there and which are utilized by collecting funds from many investors.
Yes, actually, I'd like to thank you for the good answer to that question. As you mentioned, underlying venues vary, and it's our responsibility to, account for all the requirements in, as part of the accounting, setup. But on the jurisdiction level, it's up for the regulatory authority to define the feasible, the possible investment venues. And this may vary from one jurisdiction to another, but our standards are issued in principles. For that purpose, we don't go into this much details about the different types of, jurisdictions and their requirements. We issue standards and principles, and it's later on it's up to them to try to fine tune the requirements of these standards according to their, investment environment. Okay, so any other question?
We have a couple of more questions. One is in the comment box. Is a front-end fee synonymous to a general mudarib fee? This is from Abu Hiskal.
Okay, I'll like to respond to this.
Please,
Front-end
please.
fees. So we have two types of fees. One is management fee and one is front-end fee. So front-end fee is when the unit holder is first time introduced to a fund, and in compensation of that introduction to the fund, the person who introduced the investor to the fund gets compensated. So that is the fee, which is the compensation for the salesperson who actually goes to the investor and finds him and brings him into the fund. So another concept we have here is front-end premium. So front-end premium is the income of the fund, because there may be a fund type where it has some premium assets in it, and it wants to charge something, to be accounted for as a benefit to the existing unit holders. So there are two types of fees, front-end premium and front-end fee. These are covered here. And then there is management fee. The one you are referring to is management fee, and that is for charged in the form of mudarib fee or mudarib share. And that depends on the tenure during which the investor remains invested. So that fee is the income of investment manager.
Yeah, but it as you mentioned, it would be part of the Mudarib's fees. Other structure, the different structure for Mudarba is there, and different components are there. But this would be part of. Thank you very much, Mr. Faiza. So shall we continue, or do you still have
There
any?
are two more questions. Do you want to take them just now or later?
Let's just take like every 10 minutes, we take 2 or 3 questions and we continue, because for the interest of time, we need to, wrap up before the target time. We have assigned 2 hours for the session of today. So I'm afraid we need just to move forward, and then we come back to the questions as time permits. So now the concept of NAV per share also is introduced, or unit is the amount of net assets attributable to each share or unit at end of the financial reporting period. NAV per share or unit shall be calculated by dividing the net assets of the scheme by the number of outstanding shares or units. And open-ended institutions, in the specific context of this standard, is an institution in which investors contractually and by virtue of regulatory requirements have a right to execute capital transactions, carry out capital transactions, particularly the right to redeem their investments all the time on an over-the-counter basis. Quasi-equity, this concept was introduced a few years ago, and it's part now of the framework and the financial accounting standard number 1. Just quickly, in the general context of this standard, is an element of the financial statements that represents participatory contributions. We have to highlight participatory contributions received by an institution on a profit sharing or participation basis, and it has certain features. Primary characteristics of equity, that is, in case of loss or unless negligence, misconduct, or breach of contractual terms is proved, then the institution is not liable to return the lost funds to the fund providers, and the fund providers share the residual interest in the underlying assets or business. The same concept of equity. Certain characteristics of a liability, that is, it has a maturity date or a put option of redemption, liquidation. So this makes it also much like a liability, but all in all, it has these characteristics combined in the same structure. Also, certain specific features, the rights of the fund providers that are limited only to the underlying asset or business and not on the whole or the entire institution, as well as they don't have certain rights associated only with owners' equity, such as voting rights. So in this situation, we are coming face to face with the new concept that now it is commonplace across the different standards of pronouncements, and it is one of the distinguishing features of actually Islamic accounting from conventional accounting, that emphasize on the quasi-equity element, and which constitutes the front on which the interaction between the institution and its stakeholders takes place. The standard explains here, in the specific context of this standard, quasi-equity includes the units held by investors that have a fixed maturity before liquidation of the institution itself, or put option or of redemption, such as in case of most open-ended institutions. While on the contrary, the shares or units of the institution held by the investors, which do not have a fixed maturity before liquidation of the institution itself, or put option of redemption, shall be considered equity because of the lack of these two elements. It may generally be presumed or supposed that an institution having fixed liquidation plan or fixed maturity shall have only quasi-equity. And also an open-ended institution shall have only quasi-equity. Certain open-ended institutions may have more than one class of quasi-equity. It may come in the form of the sub-funds, the smaller funds that constitute part of a larger scheme, and may own and any other institutions shall generally have equity and may additionally have quasi-equity. So as the situation might be, you have different structures depending on the underlying relationship between the institution and the investors. Sharia principles and rules, it's defined across the relevant standards, and also on the governance side, it's well defined. It comprises the Sharia principles and rules defined by certain hierarchy as appropriate. That's the Sharia standard issued by IOFI first, then regulations issued by the respective jurisdiction regulator, insofar as this entail compliance with the regulatory Sharia requirements. Then the rulings of the Central Sharia Board for the respective jurisdiction, if there is one. And then the requirements of the applicable financial accounting standards as issued by AOF, insofar as these entail Sharia-related requirements. And then last but not least, least in terms of hierarchy, yes, but it is also considered part of the hierarchy, important part, the approvals and rulings given by the Sharia Supervisory Board of the institution. So this is the hierarchy followed, and for a trustee, it is defined, and under this actually I can show you that trustee here is given in this standard for the first time. We define it here clearly. An entity appointed by the investment manager to serve as an intermediary between the investment manager and the investors, to hold the assets for investment, to safeguard the interest of both parties in line with the requirements of the legislation and or constitution documents, and to hold the final settlement funds in case of termination or liquidation of the IFI. The concept of trustee varies also across different standards, but here this is a concept just for the sake of clearing the concept and making things more relevant into this standard. This is all when it comes to the definitions. Do we have any comment and also any suggestion, any Any remarks on the concepts provided here in the definitions particularly?
Brother, there's one from Sheikh Mohammed Isa from Tanzania. His question is, a halal fund in Tanzania has issued a CIS under Wakala contract. However, they didn't put in its information memorandum neither how NAV will be arrived at and minimum return to investment. Is this Sharia compliant?
Actually, it's not called here to define, you know, what is Sharia compliant and what is not. But as I mentioned, and as also Brother Faisal mentioned earlier, we have, you know, different setups for compensation. And this compensation come in different forms according to the concept of wakala or the definition of wakala. You have the incentive, you have the fixed, you have the variable, you have the, you know, profit share. So this depends, or this is defined, can be defined, identified by the, you know, the respective Sharia authority under which, or that the institution where he works is subject to. And also we would like to refer him to our Sharia standards for that important matter, Sharia standard on wakala, and we have financial accounting standard on wakala. But our accounting standard on wakala tackles mainly the you know, accounting related concepts and treatments, but also it can provide, you know, insights on the structure of you know, compensation in the different forms and the combination thereof. So that's my answer. The Brother Faisal, if you have any comment here.
No,
We provided that in the standard. It's
Yeah.
clearly, yeah. Okay, any other question?
No, brother.
Shall we move on? So now the body of the standard, assessment of business model and selection of and adoption of accounting policies. As I mentioned, this is a disclosure, presentation disclosure, you know, standard. And then the assessment of the business model and, you know, selection of accounting policies comes, you know, at the center of this very important, you know, issue. So here, assessment, we start with assessment. An institution shall initially assess its business model, which shall form the basis for selection, adoption, and application of accounting policies, and for applying significant judgments and estimates where applicable. Such accounting policies shall be adopted in line with the requirements of relevant AOFI FASs, unless contrary to a specific requirement of this standard. Then in assessment of business model, the expectations of the investors, particularly with regard to the investment returns, distributions of profits and withdrawals of quasi-equity, shall be considered prime factors for such an assessment, along with the investment motives and investment objectives of the institution itself. Then there is a rebuttable presumption that most institutions, Islamic investment institutions, unless proven otherwise, have a business model that requires preparation of the financial statements on a fair value or as close as possible to a fair value basis. This is, I mentioned this at the beginning of the session today, that why we, you know, dispensed of or removed the concept of cash equivalent value, which was used in the old standard. Now we are, you know, could consider fair value more, you know, Sharia compliant and more also GAAP, you know, aligned. It shall not be, you know, here, however, an accounting policies to achieve the objective of fair valuation shall not be selected while compromising on the Sharia principles and rules, on the requirements of the AOFI conceptual framework for certain situations. For example, if an institution enters into a murabaha transaction, it shall follow the requirements of respective AOFI FAS, because murabaha by its own is, you know, the underlying setup for murabaha, the underlying asset, the underlying, you know, transaction is more of, you know, debt-based. So for certain cases, yeah, fair valuation may not be the right basis or measurement basis, but that's why we have to also consider respective AOFI FASs that tackle certain products and transactions instead of applying fair value accounting, and hence record receivables and revenues in accordance with the requirements of that standard. which perhaps carrying murabaha receivables at fair value. This is a very important aspect, but still we have, we are clearly defining them, the different types of, measurement basis for the, convenience of the adopters of our standards. In certain circumstances where an open-ended institution is required to or has a practice of publishing NAV per unit or per share on a frequent basis earlier than the end of the annual financial reporting period or respective interim financial reporting period, such an institution shall apply the requirements related to the interim financial reporting as per respective standard. We have a standard on that also. So here also we are referring to the respective standard. This is very important, unless otherwise the standard here itself, provides certain override situations. Is there any question? Shall we take one? Can we take one?
There's one question.
No question?
Irshad Ali Yaftali, he has asked, in most of the Islamic countries, there is different definition of Islamic Sharia and Islamic investment. Please guide us about the uniform standard which are applicable and acceptable to all Muslim countries. Is there any generally accepted institute?
Actually, this is our understanding. This is why we define the hierarchy, as convenient as possible to all stakeholders. So for certain stakeholders that don't have a layer or two of these, levels that we mentioned, they can also jump into next and the next in line, and so on and on. So that's why, depending on the country, depending on the structure of the regulatory regime in the country, certain layers may exist or may not exist, and also there is the issue of which overrides which. This is also very important. So for certain countries, you have Sharia is defined under a high level decree. In others, it's defined by the regulatory authority itself. So depending on the country, depending on where you operate, you have to follow the same hierarchy, but you have to consider what is, the layers that you have in the hierarchy, left in the hierarchy, and the layers that are, missing or not there. And we mentioned, last but not least, we said, okay, you have certain, local level, jurisdictions, local level Sharia board, Sharia supervisory board, fatwas and ahkam. So in this situation, also you can resort to, depending on the level of maturity of the ecosystem in the country in which you operate. Okay. Any other short question?
There's another request to the attendees. Please post the questions in the Q&A tab instead of chat. It will be easier for us to respond.
Yes.
Thank
Yeah,
you.
please. Yeah. So specific transactions of open-ended institutions, there is a rebuttable presumption that units of an open-ended institution shall always qualify to be accounted for as quasi-equity. Accordingly, an open-ended institution shall develop appropriate accounting policies for accounting for issuance and redemption of its units in line with the requirements of this standard, particularly including accounting policies where applicable related to a front-end fee and front-end premium, as explained by Brother Faisal. Also, NAV differential where applicable on units issuance and redemption, and back-end fee and back-end discount. All these concepts are, are well defined at the beginning. The accounting specific transactions continued. The accounting policy for NAV differential, where applicable, shall be developed, reflecting its nature in line with the contractual arrangements and the requirements of this standard. In most cases, NAV differential is not recognized as income of the institution, being considered as part of the capital transactions, as we mentioned earlier, and shall rather constitute a part of the quasi-equity along with the issued value of units. Again, I just want to remind our valued participants today that whatever we have reached in terms of accounting treatments and accounting requirements, this all is based on Sharia requirements and Sharia particularly Sharia standards. And in the rare situations where we don't have such corresponding standards, we also refer to other respective financial accounting standards. Trade date versus settlement date accounting. Accounting policy in respect of selection of trade date versus settlement date. This is a very important issue actually. And an institution has to develop an accounting policy for that. So the policy shall be developed, consistently applied, and adequately disclosed in line with the Sharia principles and rules. So the major requirements here is an institution is required to develop, consistently applied, and adequately disclose the same in accordance, with applicable Sharia principles and rules. Recognition of fee or share attributable to investment manager. Accounting policies in respect of accounting for the fee or share of profit attributable to the investment manager shall be developed, consistently applied, and adequately disclosed in line with the Sharia principles and rules in the following manner. In case of investment manager having al-wakala bil-istithmar or any other form of wakala or service ijara, based arrangement, the accounting policy for recognition of fee payable to the investment manager shall be determined in line with the requirements of respective AOF fast, duly considering the requirements for accounting for variable, contingent, and incentive fee as contained therein. And an interesting case here is FAST 31 on wakala. In case of an investment manager having a mudaraba-based arrangement, the accounting policy for recognition of share or of profit payable to the investment manager shall be determined in line with the requirements of respective AOF fast, duly considering the requirements for accounting for variable, contingent, tiered and incentive shares of profit as contained therein. General presentation and financial statements. Now, as we mentioned at the beginning, the standard prescribes the structure or the minimum, components of these statements, and it also enumerates these statements that are much relevant to the operations and the work of the Islamic investment institutions, being a specific type or category of Islamic financial institutions. The general presentation disclosure requirements, including common components of a complete set of financial statements of an institution, are to be read in conjunction with the relevant requirements of FAS 1 applicable on all institutions. This chapter in part 1 also helps define, these relevant requirements. So this would be the starting point for disclosure. For the purpose of preparation of the financial statements of the institutions, the requirements of the same chapter, part 1, applicable on all institutions, shall apply except for and unless contrary to the specific requirements contained in paragraph 18. So as I mentioned earlier, in certain situations you will come across situations where the override principle applies, and in this standard, this requirement is not an exception. So the complete set of financial statements according to this standard shall include the following: statement of financial position or statement of net assets as at the end of the financial reporting period, statement of financial activities or statement of income and other comprehensive income for the financial reporting period as a single statement unless otherwise required by the regulations or the respective jurisdictions. So as the case might be, we may have a financial activities statement or a statement of income and other comprehensive income combined in one statement, or two the different statements. Complete set complete set of financial statements. In addition to the above, this complete set includes statement of cash flows for the financial reporting period, statement of changes in owner's equity, where in the certain situation where an institution has owner's equity, statement of changes in quasi-equity, where the institution has quasi-equity or has quasi-equity in addition to owner's equity, and last, Notes to financial statements comprising significant accounting policies and other explanations. The minimum contents of the financial statements and disclosures therein. The institutions shall follow the requirements as a starting point in respect of the minimum contents of the financial statements and general disclosures, considering for sure the specific requirements contained in the paragraphs. In this standard, we have, as I mentioned, we have the basis on which we all the time we refer or we start our prescription of the requirements, and then we have certain areas or certain paragraphs where this standard has the upper hand, has to be applied first and has to be given the certain priority. Settlement of statement of financial position, the NAV per VAR or unit at the end of the financial reporting period shall be presented on the face of the statement of financial position of an open-ended institution. Disclosure shall be made of the bifurcation between the division between the undistributed, accumulated, comprehensive profit or loss being realized or unrealized, being distributable or undistributable. Any questions so far?
Yes, we have two questions. One from again from Syed Imtiaz Abbas Hussain. This draft covers close-ended mutual funds in definition. Can III do this business as well? Because it is highly risky.
We mentioned that. Yeah, this was mentioned at the beginning that the III institution itself can, do the business itself, be part of that business, and also as part of its business model, it can also play different roles depending on the as per its constitution or the institutional documents as per its defined mission and the investment motive as applicable. Any other question?
There was another question. It was with reference to paragraph 10 in what's meant by fair value accounting in third last line of paragraph 10 in assessment of business model and selection and adoption of accounting policies.
Actually, you know the concept of fair value. Fair value, we consider fair value, a closer concept to by which we can meet the Sharia requirements, because Sharia requirements are mainly based on the concept of fairness. And fair value, it's also a concept and measure of value used by in GAAP and globally. It's a very commonplace measure of value, and for that purpose, we feel that it better reflects the rights and obligations of different parties in the underlying scheme, rather than resorting to other measures that may be a bit biased or not in favor of the investor or the company itself. So fair value as a concept, it's a very well-known concept, and it's for us it's much closer to Sharia compliance, and for such areas where investments are involved and assets, particularly assets related to certain types of assets like physical assets, that the fair value is much suitable for certain types of like financial assets and other types of intangible assets. We have different sets of measure basis, but for that's in the arena of investment and investment at large, the applicable measure of value is fair value. It's commonplace and used in all circles of in this area and in accounting, particularly in accounting for this kind of investments. So this is much closer to fairness and justice. That's why it's used, and actually our Sharia standards also in different, different areas and different types of assets, particularly those assets where, you need to resort to the market and to see the, you build your decision on the, that specific nature of the interaction between the two parties, for example, an arm's length transaction, knowledgeable buyer and seller. All these, concepts are reflected in the fair value, measure. So we feel this is much closer to market reality. Yeah. Any other questions? Shall we continue? Brother Faisal, do you have any comments?
So
You're still
regarding the business model, the business model of Islamic investment institutions which are open-ended is usually to invest till the unit holder asks for his money back. So
withdraw.
when he wants the money back, the institution has to dispose the investments he has made. So therefore, we have asked the Islamic investment institutions to assess their business model to develop their accounting policies, because fair value is better accounting policy for as my brother Maj explained, but there may be an assessment that the unit holder may not ask for money till certain time, and that may allow the investment manager to adopt other allowable accounting policies as well. But this should be driven by the business model of the Islamic investment institution.
True. True. It will govern the entire period, actually, until the time of withdrawal. Thank you, Brother Faisal. So shall we continue? Saira, do you have any questions or we continue?
We have one more question. Irshad Ali Yaftali. What's the standard of setting up policy rate of Islamic investment, as most of the Muslim countries have mixing up conventional and Islamic investment through central bank discounts policy rate? What is the role of AOF in this matter?
Actually, you might have, mixed up the concept of policy here. We are talking here about accounting policies, not, monetary or regulatory policies, if that's what I understood. Here we are talking about institution level policies, accounting policies for the institution that are, instigated by the institution itself, self-imposed by the institution itself, as per, applicable rules and regulations for sure, but it has nothing to do with the discount rate or the regulatory level, policies that govern the money supply, credit extension in the economy, and so far, etc. So I mean, the concept here is more into the internal policies of the institution.
On the governance side, we do have a standard on benchmark rating.
Yes. But yeah, again, this is, out of scope. And there was a discussion with the IFSB just last week. Mr. Riyas was here, and IOFI discussed through Brother Omar. Brother Omar attended the meeting, and we were also part of that meeting. They were talking about the joint project on the benchmark. And then there was a lot of, discussions on that. And so far we feel that, we may have different models for application and different scenarios. It is not like one size fits all. And that what makes things here more complicated when we trying to come up with a benchmark, thing. So I feel, yes, as you mentioned, we've been working with IFSB for a long time on that, but still it didn't bear fruition so far. But we hope that we can, at least come into some like common ground on that, inshallah, in the future. And anything else? Any question? Any suggestion? Usually in our public hearings, certain participants at times they suggest rewording, rephrasing of certain paragraphs, or this time it didn't happen. So we feel that the standard is up to its intended shape, inshallah. Shall we continue?
There's a general question. Somebody's asked in the chat, what is the difference between closed-ended mutual funds and open-ended mutual?
Brother Faisal mentioned that closed-ended, you cannot redeem, or you can in either way you cannot move in and out until the end of the the defined maturity period of the fund, the life of the fund. So for open-ended, yes, you can anytime. It's up for investors to enter and exit and receive their rights, their balances, and this is allowable from day one. For closed-ended, it's not allowed. So you have to stick to the term, the engagement of the funds, the term defined by the institution or the fund, and all you have to do is just sit doing nothing. You have to wait until the end of this period. Brother Faisal? Open-ended versus closed-ended. I think it is a conventional concept.
Yes, I think you have clearly explained it. In open-ended funds, a unit holder can bring new money into the fund and take out his existing money also whenever he wants. But in closed-ended fund, he cannot inject more money into the fund, and he has to
Even more investors, Brother Faisal.
yeah, he cannot put more investments or withdraw his investments from the fund. But normally closed-end funds provide an opportunity to trade the share of the fund. So they are normally listed. So those funds could be sold to another shareholder to generate cash. But you cannot sell the units to the fund to get the money out of the fund. You can sell it to another shareholder.
Secondary market.
Secondary market, yes.
Any other questions, or we continue? So here, the statement of financial activities, as we mentioned, or statement of income and other comprehensive income, as the situation might be. Disclosure of earnings per share, EPS, shall be made by all institutions, excluding open-ended. The brothers Faisal just mentioned that, in accordance with the requirements of relevant AOF FAS. Disclosure shall be made of the, as we mentioned, by a division between the net comprehensive income or loss for the period, being realized or unrealized, being distributable or undistributable. This is here mainly relates to certain disclosures. Statement of changes in quasi-equity. To the extent applicable, the following information shall be disclosed on the face of the statement of changes in quasi-equity. And again, for those institutions that have quasi-equity. Value of units and distributed income, accumulated loss as of the beginning of the period, and proceeds on issuance of units during the period, disclosing the following: number of units issued, front-end premium charged on units issued, and NAV differential on units issued where applicable. Statement of changes in quasi-equity continued. Also, payments or redemption of units during the period shall also, the institution shall disclose the following: number of units redeemed. This is on the other side: back-end discount applied on units redeemed, and NAV differential on units redeemed where applicable. Continuing here, the same statement. Net comprehensive income or loss for the financial reporting period, distributions to investors during the period, and value of units and distributed income or accumulated losses in the opposite scenario as of the end of the period. Statement of changes in quasi-equity continued in case of more than one class of quasi-equity, such as the case of having multiple sub-funds. The statement of changes quasi-equity shall provide the necessary information through a columnar presentation or through notes, in respect of, this is for comparison, sake of comparison, easing out the comparison in respect of each material class of quasi-equity. So this again is in line with the principle of materiality, and if it is material, yes, we have to disclose it and provide disclosures. Otherwise, it is not a requirement. Statement of changes in quasi-equity continued. An institution shall disclose the following transactions for the period in the notes to the financial statements. The front-end fee paid by investors to the investment manager directly at the time of investment, and the back-end fee charged to the investors and paid to the investment manager and the balance thereon. Minimum contents of the financial statements and disclosures continued. Now, investments, insofar as applicable, disclosure of complete movement of investments in individual investment instruments shall be made, including the amounts and number of shares of units of investment purchased, acquired, and sold during that period. Also, considering the business model of the institution, additional disclosure shall be made in respect of the investments, such as disclosing portfolios, their subcategories, etc., in addition to the disclosure requirements for such investments in line with the relevant AOF phases. Again, continued in investments, disclosure shall be made, also be made of the value of the investment if it is not available with the investment custodian, the trustee, and the reasons thereof, segregating or distinguishing between any investment used as a pledge during the trade and settlement of any exposure during that period through the stock exchange, and if any investment is recognized in the books of account but custody is not yet received. So this is again has, because the impact of that would be substantial on the financial accounting. So even at times of if you have entered into the contract but still the contract has not been executed, you have to also provide disclosures on that. Sub-funds, in case of an entity or institution having sub-funds, disclosure shall be made with regard to each material sub-fund, again material sub-fund, as if it is an operating segment of the institution in line with the requirements of the respective FAS. Investment manager and trustee now treated or looked at or perceived as related parties. An institution shall disclose necessary information in respect of the transactions, balances, and non-monetary interest, along with a brief description about the contractual relationship with the investment manager as well as the trustee, considering these parties as significant related parties in line with the requirements of respective AOF FAS. Risks related to disclosures. An institution shall provide risk-related disclosures or risk-related disclosures, and an institution shall provide risk-related disclosures in line with the requirements of respective AOF FAS. We have certain, standards that, account for this specific area in the work and operations of Islamic investment institutions and broadly Islamic financial institutions, such as FAS 35 on risk reserves. Risks related disclosures continued. In addition, an open-ended institution shall disclose the following when its investment portfolios contain investments which cannot be liquidated on an immediate basis without significant pressure on price, considering the size of the investment in the portfolio in comparison with the liquidity of the investment in its related market. This is very important. The proportion of such investments against the total investment, because here you have, you cannot dispose of this, investments immediately. So you need to identify the size of these, investments compared to the overall size of the portfolio or the institution. So this also helps users of financial statements have an idea about certain elements of risk. The risk mitigation techniques applicable or available to the investment manager to manage such risks, including any arrangement of Sharia compliant financing to meet the redemption requirements in specific circumstances. So in certain situations, you have the entity, the institution may secure Sharia compliant financing to just meet these kind of, last minute, withdrawals or unplanned for, movement. So in this situation, also disclosure should be made about that. Under the same title, risk related to risk-related disclosures in case of an institution or any sub-fund within the institution is established for a limited period, its maturity date shall be disclosed, and where necessary, disclosure shall be made about the scheme of redemption and managing liquidity for such purpose. The rating of the investment manager and the ranking of the institution and, where applicable, of the respective sub-funds shall be also disclosed, along with the name of the rating agency and that has provided the rating and the period during which the recent rating is applicable. This is also very important because it's also, provides crucial information to the users of financial statements of the entity, the institution, about any possible, potential risks that, lay ahead. This is all for the standard. Effective date would it's planned to be on or after the first, once it's issued, I mean, on the 1st of January 2027 or thereafter. But in all situations, under different scenarios, we as AOFI encourage early adoption, and institutions time to time, yes, they adopt these standards even before the effective date comes into application. For this standard, we have, because as we mentioned, we developed this standard based on old standard. So we provide certain, transitional provisions for institutions that will consider, migrating towards the new regime. If and only if adoption of this standard results in significant changes in accounting policies for an institution which has a fixed maturity, such institution may decide to continue the existing accounting policy, but under the conditions that it has completed substantial period till maturity as of the date of financial reporting, and the remaining period till maturity is not more than 2 years from the date of financial reporting. In this situation, yes, the institution can continue its old accounting policies until the change takes place and the standard is fully adopted. Amendments to other standards. This standard supersedes, as we mentioned, the earlier FAS 14 investment funds, but it doesn't amend other standards insofar as certain aspects of investments, funds and investment companies is covered under the chapter that we refer to in FAS 1, unless in the case of certain requirements that are provided here and prescribed under this standard, which shall have priority in terms of application. So once this standard is issued, it will supersede the old standard, and the effective date, as I mentioned, will be inshallah in the 2027 onwards. That's all from my part. Do we have any other questions, any comments from our colleagues, Brother Faisal? Any of our valued participants want to provide any comment? Please proceed.
There is one general question, general comment from the participants. Sister Susan Safat, she has said it will be better that we have a unified set of standardized Islamic models for the Islamic financial institutions in use, and to be fully accepted by Sharia and to be applicable to the latest accounting standards.
So he means by business models, by that business models. Actually, business model is driven by many aspects. It's not it might not be that much possible to just define a set of applicable business models for certain areas. So business model is wider in concept actually, and it at the time to time you can come across even different models within a very short period of time for certain reasons. So that the institution at times, though it is not that much encouraged that an institution changes its business model so frequently, but this might be, at times, a reality of life because of certain, cases, certain scenarios, certain, at times, crisis, dictate. At the time of crisis, institution may need to reconsider, as we've seen in at the time of, epic of, the COVID epic that broke out 3 years back, and it just made institution reconsider a lot of their on current business models and current operations. So this is by just coming up with what's an acceptable business model and what is not. I think we are just limiting the sphere of available options and scenarios, because if you look at the definition of business model, it's a way an entity manages its assets or resources, economic resources, for the purpose of collecting cash flows. So how come that I narrow down these alternatives and options for the institution? This can take place at a different level than accounting standards. Brother Faisal, do you have any comment here?
Yes, you're right. Business models could be multiple. So we are very we thought we consider ourselves in a challenging position when we were compiling the invest standard, because considering the different business models available, it was difficult to suggest accounting policies. So when wherever we were confused, we referred to the basics of Islamic principles, and then we tried to compile those rules, standardize the practices, and leave the accounting policies mostly to the choice of the uh, investment managers, so they can choose based on their requirement of the unit holders and the requirement of their assets and different types of stakeholders. They can choose the accounting policies that fit the most. Setting out one business model for investing is not appropriate, because some investments require more time period, some require less time period. But we have unified the Sharia principles here, and the accounting policies that should be adopted according to those.
Thank you, Brother Faisal. Maybe our valued participants, maybe he also meant that we just come up with an exhaustive list of these models, such as hold to collect and sell, and etc. So, but still, again, we cannot confine the operations of Islamic financial institutions into just a couple of models and just consider that you are coming up with the Sharia compliant methodology for selection of business model. We actually at IOFI we issue standards and principles when it comes to certain components of operations. We don't dictate which models to follow and which models not to follow, because unless the model itself has no Sharia connotations and no conflict with the terms, you may apply, for example, a model that is seems to be Sharia compliant on your assets, but when it comes to your financial assets, it might not be Sharia compliant. So you cannot apply the same model across all different categories of assets. This is what I mean. So that's why we leave this, critical issue to Sharia approvals, to the management of the institution for their, consideration, internal consideration, external, applicable rules and policies. But we don't usually recommend or publish an applicable or approved list of models for institutions. This is in principle. Any other questions, Saira?
Yes, there's another question from an anonymous attendee. It's a general question. when somebody is investing his or her money in Islamic mode, principal amount is directly invested or based on unit price. How can an individual satisfy that the profit which is generated from the invested money is halal and the direction is acceptable as per Islamic investment process?
Actually, we have to leave that to you have different mechanisms that by which you can you make sure that your investments are Sharia compliant. The institution is itself, the constitution of the institution itself, the investment motive, all these kind of documents, prospectus. You have multiple instruments whereby you can make sure that your investments are Sharia compliant. And at that point, once you enter and once you invest your money, surrender your money to the custody of the investment manager, it's up now to the entity itself. It's up to the manager itself to make sure that they meet the Sharia applicable Sharia requirements and they follow or operate according to the issued applicable standards such as IOFI standards, whether financial accounting standards or Sharia standards. Yeah, but at that point, you do your best before selection of the venue, and later on, it's once you place your funds, it's now the mandate of it falls upon the institution and its management and its Sharia board and its different like stakeholders to make sure that the income earned is Sharia compliant. Again, as you mentioned, Sarah, it's a very general question. So that's it today. Saira, no more questions. Our team.
There's just one more question. Sheikh Hisham has asked, what should institution do if regulator does not adhere to the application time of such standard? Otherwise, not put also the transitional phase for new standard.
Sheikh Hisham, salam alaikum, first of all, and thank you for being part of this public hearing session, as usual. Actually, Sheikh Hisham, we mentioned at the beginning the applicable hierarchy for application. So that's why we, as I mentioned, you have different scenarios where you have, for example, layer 4, but layer 3 is missing, or layer 3 is there, layer 2 is missing. So at times you give like priority because of this is reality, market reality. The regulators in the country, want to heavily regulate certain areas, and they may have come up like higher on the hierarchy before other levels or layers. So it can all this can be defined by the regulatory authority. For IOFI, we have just that kind of soft power. We can do certain like more moral suasion, approach, but we cannot once our stakeholders are they adopt our standards and they adopt these standards on a mandatory basis. So now it's up to the regulatory body to make sure that application and implementation takes place according to the set standards. But as IOFI, we cannot go into the regulatory bodies or even to the market players and try to impose our requirements directly. So based on the hierarchy provided, the process may follow different scenarios. But again, the regulators have usually have more market power in their own jurisdictions. Any other questions, or we'll conclude?
There are two more questions. Mohammed Kashif has asked, the financial statement and related corporate governance framework is the reliable resource to confirm the level of Sharia compliance?
Is it enough or sufficient, you mean? What was the question exactly?
Reliable source.
Reliable source, yeah. Yes, we assume that, because this is the ecosystem. This is, you know, when it comes to different stakeholders, major stakeholders that are involved in the process of you know, Sharia compliance and governance. As a UFI, we issue standards. Regulators apply these standards. We have other like standard setters who also issue standards in this area, and they also do their best to make sure that these standards are applied. And in certain situations, you have many central banks, you know, taking part on are members of these standard setter bodies. And so it, as a process, it is not like, it's not like, you know, just of the shelf solutions for this particular issue. It is about, you know, a dynamism that takes place and is, you know, affected over time. It takes, you know, much of dialogue and much of you know, interaction between the different parts involved in the process. And once, you know, you have the components, at least now, alhamdulillah, we have the components. Now application, when it comes to application, yes, at times application is not that much ideal, but the major component is the you know, the the ground. We set the ground for this process at different levels in terms of the standards, in terms of the internal organs that can be there in the institutions. You have Sharia Supervisory Board, you have at the level of the regulatory body, you have the Central Sharia Board. So you have different mechanisms and different tools whereby we can make sure that you know, we reach some sort of, you know, acceptable level of adoption and compliance, adherence to the set rules and principles. But still, it is, we are not in an ideal world. You know, you may come across different, you know, different types of or source of, you know, market realities, where in certain countries you have a matured experience. In other countries, they are still at the, you know, at the very like nascent stage. So it depends on, you know, market reality in the country where the institution is operating and is based. For certain institutions, they take it up on themselves to apply our standards, you know, even without any imposition from regulatory bodies. But this is also, you know, possible. So in real life, you may come across different scenarios, but again, the intention is very, very important. The motive is very important. Okay, the drive is very important. So if you have these elements, yeah, for sure, wherever you are on the face of earth, you can, you know, make sure that you apply these set principles and rules. Even in America, you have certain, you know, institutions in America that they make UFI standards as, you know, mandatory for them, though this imposition doesn't come from above, from the regulatory bodies. But still, when it comes to their auditing of their financial statements and their operations, yes, they comply with our, you know, standards and make it like mandatory for their work. So it has nothing to do with, you know, where you operate. Insofar as you have the intention, you have the motive to, you know, comply with Sharia principles and rules. Any other?
There's a suggestion and another question. Brother Mukawi Ismail has suggested in the introduction, number 4E, not related to the standard, can be mentioned in the footnote. 2 in the scope, paragraph 6, which AOP standard is applicable. Appendix B,
Just one by one. He has suggestions for phrasing and wording, or which para again?
In the introduction, number 4E.
Number 4E, yeah. Okay. Yes.
Introduction.
Introduction or not definition? Okay, introduction. For A or E?
E. E for Egypt.
Okay, scope, intro E. This is introduction actually. IN1, IN2, IN3, IN4, E. Huh? here. Here.
Yeah,
So what's a suggestion?
not related to the standard can be mentioned in the footnotes.
Not related to
Probably
this
he
thing.
wants us to move 4E to the footnotes.
Okay, as he thinks that it is not like a proper significant change. It's just like a remark. Yeah, but actually, yes. Why we consider this as a significant change? Because historically, chronologically, our standards used to also cover certain aspects of governance, even within financial accounting standards. But now we consider this a major move where we are taking all these requirements into their respective standards. So we mentioned that actually this para E is mentioned in many standards that have been issued recently. Because now we are emphasizing more on the accounting treatment, accounting process, not on any governance issues. And that's why we are leaving all these governance requirements to the respective standards. But we mentioned that because this is, yes, because certain people may come and say, okay, you are not covering, as the old standard used to do, you are not covering certain governance requirements. So we have to make it clear why we are migrating from the old system into the new, regime. But again, we can, his comment is noted. We will make it part of the, full set of comments for this particular public hearing. Any other, did he mention anything else?
He's got two more suggestions. One is relating to the scope paragraphs. This, which AOP standard is applicable? And in Appendix B, basis for conclusion is needed.
Yeah, based on conclusion, yes, we will provide that. Actually, it's already there. I think we developed that
Yes.
policy, and it is it was thoroughly reviewed by the team and the management. Yeah, we provide that if they insist on that, we can provide it in later on, make it part of the exposure draft, final exposure draft posted on the website for sure, if they insist on that.
The next comment is from Syed Imtiaz Abbas Hussain. How does this draft ensure an investor that financial affairs have fully considered transparency and accountability to a satisfaction level?
Brother Faisal, please. Transparency and transparency in the financial statements of IIs. Did you get the question?
Yeah, so this standard covers the accounting policy part related to the valuations of investments. Whenever you have the money responsibility, the fiduciary responsibility, the valuation becomes the most important element of it, because through that part, there is a chance that one unit holder gets benefit over another unit holder. So here, consistently applying the accounting policies and referring to the relevant standards and suggesting the requirements of account related to accounting ensures that the valuation the unit holder gets during the period of his transactions is as per the assets valuation, and it keeps him at par and at no advantage or disadvantage with the existing unit holders. So this is why we have standardized the accounting requirements here. I hope this covers the question.
Thank you. Yes, Saira, any other questions?
It's just in continuation to, it's a remark, not a question. Sheikh Hisham has stated, this is why we need to harmonize our standards to the international accounting standards to be more applicable in our jurisdictions. Of
Actually,
course, from Islamic standards perspective.
this is a major consideration now in the agenda of the accounting board, alignment and realignment of GAP and other international specific international standards like IFRS. This is being taken care of. I can assure you, Sheikh Hisham, different levels in many standards that have been recently issued. This alignment is considered, unless in the certain situations where there might be Sharia, violation elements or Sharia issues. So this is now part of the board strategy, actually. Any other?
No, that's all.
That's all. Okay, let's conclude. If there is no more questions. Now back to the team.
Ladies and gentlemen, distinguished participants, as we have reached the end of today's public hearing session on the newly issued exposure draft of Financial Accounting Standard on Financial Reporting for Islamic Investment Institutions, I would like to thank Mr. Majd Bakir, Director of Standard Development Department, for the thorough presentation of the exposure draft and the new answer provided to participants' questions and comments in today's session. We would like to also extend heartfelt thanks to all our valued participants from across the Islamic finance industry and beyond for having taken part in today's session. And for our institutional partner, ISRA and SIF Malaysia, that provide their support to this session. Your comments and suggestions are essential for IOFI in improving and fine-tuning the exposure draft for finalization of standard by IOFI Accounting Board for issuance. All relevant comments and suggestions will be compiled and presented to the respective working group to consider and make the change as deemed appropriate the exposure draft. Thank you all, and see you in the upcoming future IOFI public hearing session.
Thank you very much. Also, a word of thanks goes to our brother Faisal Hafiz. Thank you very much, sir, for being with us and taking the effort to be part of this important public hearing. Thank you very much. I would like also to extend thanks to the team. Thank you very much, everybody, and to our partners. Thank you very much. And inshallah, we look forward to seeing you in the near future. Thank you. Assalamu alaikum.
Assalamu alaikum.